you are looking for the quickest way to file taxes with stock investments, here are the steps you need to follow right now. Let's first talk about reporting transactions. So how do you actually report stocks on federal and state income taxes? Well, unless your investment are in a retirement account, such as a 401k or IRA, you'll have to report all of your stock transactions to the IRS every year. And if you live in one of the 43 states that actually assess state income taxes, you'll have to report your trades to your state. Very important to remember that, not just federal here. We're speaking about state reporting also. Profitable stock trades will result in taxable gains. If you held your stocks for longer than 1 year, you will benefit from the lower capital gains tax rate rather than the ordinary income tax. In other words, if you held the securities for less than a year, your ordinary income tax will apply. Very important to remember that. So you want to gather your 1099s. If you make stock trades during the year, your financial services firm will send you a Form 1099B, okay, at the end of the year with relevant information for your taxes. And you'll get one 1099B from each firm where you place the trade. So you'll need to wait until you get all of your 1099s before you can correctly file your taxes. Very important. And you want to divide trades into short-term and long-term. So timing is really important here. So since long and short-term trades are taxed at different rates, you will need to segregate your trades by your holding period. So short-term trades, again, I want to repeat here, short-term trades are those held for 1 year or less, and long-term trades are those that are held for more than a year. So you want to actually collect information that's not on 1099s if required. So starting in 2010, financial services firms were required to keep cost information for trades and report this information on 1099. So if you have held a stock since 2009, your firm may not have all the relevant information on your trade, such as your cost basis or date of purchase. So you need to come up with this information from your own records. Again, we want to be honest here. It's not about, trying to fudge numbers or all that kind of stuff. No. By the way, when I speak about financial services firms, I'm speaking about all kinds of firms, including brokerages. Okay, it's very important to remember that. So investment banks, regular banks, brokerages, any place where you are holding a securities account, a brokerage account, and you are getting a 1099B from, then this will apply. Okay, so you want to check the appropriate box on Form 8949. If your transactions were reported on Form 1099B, including basis, you want to check box A. And if your information comes from a Form 1099B but does not include cost information, you want to check box B. If your trades were not reported on Form 1099B, you must check box C. By the way, we have actually dedicated an entire video to Form 8949. So if you're interested, you can actually go into our video catalog, our playlist on tax filing, and just search for 8949. You'll have it there. We have a 20-minute video, in-depth video that explains everything. But if you still need help, please feel free to actually ask us in the comment section, and we'll certainly get back to you. Not a problem. What I want you to do really right now is that I want you to really, by the way, welcome back to the channel. In today's conversation, we are, of course, speaking about how to file taxes with stock investments. One thing you need to really understand here is that you need to enter stock information on Form 8949 per IRS instructions. Those instructions are very detailed. You'll need to provide the name of your stock, your cost, your sales proceeds, and the date you bought and sold the stock. Very important to remember the timing. Timing is really important. Why? Because timing actually determines whether we are speaking about a short-term transaction or a long-term transaction. So short-term transactions go in part 1, while long-term transactions go in part 2. And the thing here is that you'll need to adjust your gain or loss. So this is really important because if you have to do that, you'll have to provide a code to the IRS informing the agency of the reason for your adjustment. Some people actually like to attach an explanatory note to the agency so that the IRS auditor, the IRS reviewer will have a clear understanding of what's really going on or what's really went on, okay, what really went on. So you want to transfer information to Schedule D per IRS instructions, depending on whether you checked box A, B, or C at the top of Form 8949. You must enter your short-term transaction, your short-term gain or loss information on line 1, 2, or 3 of Schedule D, respectively. Long-term gains and losses must go on line 8, 9, or 10 of Schedule D, again, depending on whether you checked box A, B, or C for your trades. Very important to be precise here. You want to calculate your gains and losses, follow the instructions for Schedule D to total your short-term and long-term gains and losses. And you want to transfer information to Form 1040, again per IRS instruction. For short-term gains or losses, or losses, you want to transfer the information to line 13 of your Form 1040. One thing I want to say here is what? Everything I'm telling you, this really applies if you are filing manually, because if you are going to file with tax software, the software will take care of everything automatically. You don't have to sort of track what goes on which line, box A, B, or C. No, you just answer. You just go through the questionnaire that the tax software actually proposes to you, and once you enter the right information, the software will take care of the rest. Okay, it's really important to remember that the thing is, we have a long-term gains. They are taxed at a lower rate, right? So basically, you'll need to compute your tax using the Schedule D worksheet before transferring the tax amount to line 44 on your Form 1040. So you want to copy federal information onto state tax return if you require it. Again, if you have software will do it for you automatically. I want to talk to you about the Schedule D. I mean, I really want to dig deeper because I think I've talked about it, but I want to dig deeper. By the way, I want to really remind everybody that today's topic is how to file taxes with stock investments. We're spilling all the beans you need to have so you have a clear idea of how to file taxes with stock investments, okay? Now, so let's dig deeper. I want to dig a little deeper here. Schedule D, how do you report your capital gains and losses to the IRS? Now, if you have realized profits on, let's say you have realized profits on your investments, you want to actually, you need to report those transactions to the IRS on Schedule D, okay? And you have to see how much tax, if any, you owe. But it's not all bad news. If you lost money, this form helps you use those losses to offset any gains or a portion of your ordinary income, reducing the taxes you owe. And if you have profited from your transactions, Schedule D helps ensure that you don't overpay Uncle Sam for your gains. Very important. So what is really Schedule D? Again, we have actually dedicated an entire video to Schedule D also. So if you're interested, go to our catalog or you just ask us a question in the comment section, and we'll certainly send you the link to that video. So Schedule D basically is an IRS tax form that reports your realized gains and losses from capital assets, that is investments and other business interests. It includes relevant information such as the total purchase price of assets, the total price those assets were sold for, and whether those assets were held for the long term, more than a year, or short term, less than a year, okay? And so who really has to file a Schedule D? You'll have to file a Schedule D if you realized any capital gains or losses from your investments in taxable accounts. Very important, taxable accounts. That's the key word here. That's the key phrase here. That is, if you sold an asset in a taxable account, you will need to file. And investments include stocks, ETFs, mutual funds, bonds, options, real estate, futures, cryptocurrency, and more. I know the title of the video is how to file taxes with stock investments, but by extension, we are speaking about all kinds of investable accounts, okay? All types of investable assets, investment assets. So those who have capital losses that they are carrying over from previous tax years will want to file a Schedule D so they can take advantage of the tax benefits. Okay, and others will need to file a Schedule D as well. So those who have realized capital gains or losses from a partnership, a state, trust, or S corporation will need to report those to the IRS as well. And so those with gains or losses now reported on another form can report them on Schedule D, as can filers with non-business bad debts. And those with like-kind exchanges and installment sales may need to answer questions about their transactions on Schedule D. One thing you want to do here is that you need to detail your transactions. When we talk about actually reporting and filing taxes with stock investment and reporting your transactions to the IRS, you need to detail those transactions. So once you determine whether your gain or loss is short-term or long-term, it's time to enter the transaction specifics in the appropriate section of Form 8949. And all transactions require the same information. I mean, it's standard information, okay, and entered in either part 1 short-term or part 2 long-term in the appropriate alphabetically designated column. For most transactions, you will complete the name or description of the asset you sold, when you acquired it, when you sold it, what price you sold it for, the asset's cost or other basis, and finally, the gain or loss. Okay, so this is it's nothing complicated at all. I mean, and one thing I want to say here is that you want to total your entries on Form 8949 and then transfer that information to the appropriate short-term or long-term sections of Schedule D. On that tax schedule, you will subtract your basis from the sales price to arrive at your total capital gains or losses. Very important to remember. Now, you want to total your transactions, okay? And you would need to figure the tax on your gains. So when you come up with a gain, the tax paperwork continues. And this is where the math really begins, especially if you are doing your taxes by hand instead of using software. So depending on your answers to the various Schedule D questions, you are directed to the separate qualified dividends and capital gain tax worksheet on Schedule D, okay, and which is found in the Form 1040 instruction booklet. So these worksheets take you through calculations of your various types of income and figure the appropriate taxation level for each. So before you begin either of these worksheets, be sure you have completed your Form 1040 through line 11B. That's your taxable income amount, because that's the starting point of those two worksheets. And from there, you'll have lots of addition, subtraction, multiplication, and transferring of numbers from various forms. But if you sold stock or other property, don't be tempted to ignore Form 8949 Schedule D, the associated tax worksheets, and the extra calculations. Remember, the IRS received a copy of any tax statement your broker sent you, so the agency is expecting you to detail the sale and gain or loss with your tax filing. It's all about being a compliant taxpayer. I want to talk to you now about planning. For those of you who just caught up with us right now, I just want to repeat today's topic. We are actually talking about how to file taxes with stock investments. I want to talk to you about planning here, because there's a lot of planning that goes into filing taxes with your stock investment, so you can actually optimize things come tax time. And so will your broker actually give you a form? Yes. If you sold any investment, your broker will be providing you with the 1099-B, okay? So that's the form you'll use to fill in Schedule D on your tax return. So the beauty of this is that it is generally plug and play. Everything you need can be ripped right off the 1099-B and inputted into the tax return. Furthermore, if you receive dividends from stocks or interest from bonds, you should also receive a 1099 DIV or a 1099 int for interest. And often you'll all get all these forms in a single package from your broker, and this is supposed to be sent to you no later than January 31st. And 1099-Bs technically are not due to recipients until February 15th. Okay, and the thing here is that if you were just sitting there and just wondering what you owe in taxes on your stock gains, it gets a little tricky here. The amount you owe in taxes on your stocks will depend on what tax bracket you are in. So short-term capital gains are taxed as ordinary income, just like your paycheck. So if you are in the 20%, if you are in the 25% tax bracket, your short-term capital gains will be taxed at that amount. And if you are but if you have, let's say you have realized long-term gains, things can be not tricky, but things depend on whether or not you are filing single or you have other types of transactions. Okay, so you can have a 0, 15, or 20% in terms of capital gains taxes. Okay, and if you are, let's say, if you're filing married jointly, things can be a little more different too. So my point, what I'm trying to say here is what, when we speak about planning, we're speaking about actually thinking beforehand what kind of capital gains you are going to get at the end of the year, and actually adjusting your overall tax planning accordingly. This is very important. And also, it's always important to think about those transactions when you sell stocks during the year, to think about those transactions before the end of the year, so you know exactly how to plug and play all the data once you receive the 1099-Bs from your brokers. I want to talk to you now about strategizing. And this is an important element that actually can help lower your taxes in the long run. Okay. Generally, any profit you make on the sale of a stock or a bond is taxable at either 0%, 15%, or 20% if you held the shares for more than a year, or at your ordinary tax rate if you held the share for less than a year, right? Also, remember, any dividends you receive from a stock are usually taxable. So here is what you need to really understand that can help you actually file taxes with stock investment real quick. Now, granted, your situation may be more complicated, so be sure to talk to a qualified tax pro. This could be a CPA, an EA, or a tax attorney before making big decisions. Let's talk about capital gains taxes. So if you are holding shares of a stock in a regular brokerage account, it has to be a regular brokerage account, you may need to pay capital gains taxes when you sell the shares for a profit. There are two types of capital gains taxes. So the short term, now you understand, and the long term. Now the long term, actually, the rates are 0%, 15%, or 20%. And long-term capital gains tax rate are usually lower than those on short-term capital gains, and that can mean paying lower taxes on stock sales. This is why, not only for investment purposes but also for tax purposes, it's a lot better to sell stocks that you have held for more than a year. Okay. And what about dividends? Now, dividends are usually taxable income. So for tax purposes, there are two kinds of dividends. We have qualified and non-qualified rather. So non-qualified dividends are sometimes called ordinary dividends. So the tax rate on non-qualified dividends is the same as your regular income tax bracket. And the tax rate on qualified dividends is 0%, 15%, or 20% depending on your taxable income and filing status. This is usually lower than the rate for non-qualified dividends. In both cases, people in higher tax brackets pay more taxes on dividends. And so how and when you own a dividend-paying investment can dramatically change the tax bill on the dividends. Okay, so we actually have covered this on another show also. But if you want to dig a little more, you can just go to IRS publication 550 for the details. There are many exceptions and unusual scenarios with special rules. So this publication is worth reading. Let's quickly talk about how to pay lower taxes on stock. And this is really important. If you want to pay lower taxes on stocks, you want to do a few things. You want to think long-term versus short-term. I just said that before. You might pay less tax on your dividends by holding the shares long enough for the dividends to count as qualified. Just be sure that doing so aligns with your other investment objectives. And whenever possible, you want to hold in assets for longer than a year so you can qualify for the long-term capital gains tax rate when you sell. And that tax rate is significantly lower than the short-term capital gains rate for most assets. But again, be sure that holding the investment for that long aligns with your investment goals, because you're not just holding an investment because you want to align it with tax purposes. Okay, you have to think first about the investment purpose itself. So think long-term versus short-term. You want to use investment capital gains. You want to use investment capital losses to offset gains. So the difference between your capital gains and your capital losses is called your net capital gain. If your losses exceed your gains, however, that's called a net capital loss, and you can use it to offset your ordinary income by up to $3,000, $1,500 for those married filing separately. And any additional losses can be carried forward to future years to offset capital gains, or up to $3,000 of ordinary income per year. And that's the second option. So if you want to pay lower taxes on stocks, think long-term versus short-term. Use investment capital losses to offset gains, and hold the shares inside an IRA, 401k, or other tax advantage account. So dividends and capital gains on stock held inside a traditional IRA are tax deferred and tax free if you have a Roth IRA. Dividends and capital gains on stocks in a regular brokerage account typically are not. So once money is in your 401k, and as long as the money remains in that account, you pay no taxes on investment growth, interest, dividends, or investment gains. You can convert a traditional IRA into a Roth IRA so that withdrawals in retirement are tax-free. Okay? And one thing I want to say here is that you need to note, though, that only post-tax dollars get to go into Roth IRAs. So if you let's say if you deducted traditional IRA contributions on your taxes, and then later you decide to convert this to a Roth, you'll need to pay taxes on the money you contributed, just like everyone else who invests in a Roth IRA. It's very important to remember that. And a backdoor Roth IRA allows individuals with higher income to enjoy the benefit of a Roth IRA despite the IRS income limits. Thank you so much for your attention in today's conversation. I was quickly talking to you about how to file taxes with stock investments, and so I spoke about reporting transactions, Schedule D, planning, and strategizing. God bless you. If you have any questions, please drop them in the comment section. We'll certainly be glad to, we'll be very happy to answer you. But until next time, please remain marvelous.